Today we're going to talk about the hidden fees and extra taxes that you pay when you invest in annuities. I've been a financial advisor for over 25 years. I've met with over 300 wealthy families throughout my career. I've seen dozens and dozens and dozens of situations where families were sold annuities and they were unaware of the amount of hidden fees and hidden commission inside the annuity contract. And that is because the majority of financial advisors who sell annuities to their clients straight up lie about what the cost structure truly is. That's been my experience. How else could it be that I've met so many people throughout my career who owned annuities and they were clueless about what the fees were, and they had even asked, in many circumstances, their financial advisor or former financial advisor, hey, what are the costs in here? What's your commission? And nobody ever gets a straight answer. So I'm going to show you how it really works. I'm going to show you the fee structure for annuities, and we're going to review the extra tax burden that is imposed upon you or your beneficiaries when you buy one of these terrible products. Let's start with the annual fees that you would pay for your typical variable annuity. If you put $1 million in your typical variable annuity, you can expect to pay about 3.75% per year. That's $37,500 per year in ongoing fees forever in your contract. Average rates for the three cost components: 1.5% for mortality expense and administration, 1% for management of the investments, and 1.25% if you get optional benefits, such as a lifetime income rider on the policy. In my experience, and I have a lot of empirical data, investors don't know the sum total of all those fees. Usually they know about one of them. Oftentimes it's the lifetime income rider. Oh, my financial advisor said I'm paying 1.25% in this contract. But the advisor didn't tell them about all the other costs. They don't have to. The financial advisor who pitches annuities just relies upon the fact that you're signing documents that basically say, yes, I'm aware of everything going on here. There's lots of fine print, right? And you get a prospectus in the mail, and unless you're a securities lawyer and worked as a financial advisor and know how to read these complex documents, it will be difficult for you to determine the actual amount of fees that you're paying in the contract. Now that we've covered the hidden fees, let's take a look at the hidden commission. Here's a standard commission for an index-linked or a variable annuity: 7 points. Here we put in $1 million. The financial planner gets 7%, $70,000 on the spot. They get the whole thing the moment you buy the annuity. Now you can see why financial advisors aren't honest about the fees. Could you imagine going to a financial planner and saying, hey, I want to invest $1 million, but how much is it going to cost me? And the planner says to you, you're going to pay me $70,000 right now. And oh, by the way, you're going to pay about $40,000 per year forever in fees. Who would sign up for that? No one. No one would sign up for that. And that is why there's no transparency. That is why financial advisors don't have to tell you what the fees are when you buy these products. They rely upon the tricky disclosure, that big prospectus that you get in the mail that's really complicated, has lots of small fine print. That's where the fees are. It's buried in there. It's complicated. And they're relying upon you not being able to figure it out. And they're not going to tell you what the fees are. Or what I've seen, unfortunately, in many cases, is that a client asks the financial planner, advisor, whatever you want to call them, hey, what are the fees? And they get part of the truth. It's very rare that somebody gets the whole story. If you are sold an annuity or someone's currently pitching one to you and you are trying to determine what the commission is on the product, let me show you how to figure that out. Somewhere in the marketing documents, you'll see a CDSC table. That stands for Contingent Deferred Sales Charge. And what that is a schedule to claw back the commission paid under the table, hidden from you, to the financial advisor. Whatever the charge is in the 0 year, and oftentimes the first year. Whatever that percentage charge is the amount of commission that the financial advisor received on the product. The commissions for annuities are not a level playing field. Therefore, the financial planners who sell annuities have extreme conflicts of interest. You can see from my example table that by changing the share class or the type of annuity, the financial planner can get paid a lot more or less. And therefore, when you buy an annuity from a financial planner, are you getting the annuity that is in your best interest or their best interest? I want to come back to the CDSC table for just a second. I cannot count the number of times over the last 25 years that I've met with someone and they wanted to get out of their annuity contract only to find out that they had a huge penalty to get out of the contract and they were completely unaware of it. The financial planner who sold them the annuity never told them that, hey, you have to be in this product for 7 years before you can get out of it without a penalty. And that's because I'm getting a 7% commission. Nope, never said a word. It's unreal how many times I've met with people and they didn't know about this CDSC table. Now let's quantify what those extra fees for the annuity can cost you throughout your lifetime. Owning a variable annuity can cost you millions of dollars throughout your retirement due to the excessive fees in the annuity contract. When you buy a variable annuity, you are given a menu of investment options inside the annuity shell. Those investment options are often basic indexes like S&P 500, mid-cap, small-cap, emerging markets, bonds, etc. Well, you can buy all that on your own and save yourself the expense of the annuity shell. If you bypass all the fees of the annuity and invest on your own, then you can probably do at least 2% per year better because you're cutting out a lot of fees. In this example, I'm showing what happens when you have a 2% performance gap over a standard retirement of 25 years. Let's say you put $1 million in indexes and funds or $1 million in a variable annuity. In both cases, you have the exact same asset allocation, same portfolio. The only difference is you're paying a lot more with the annuity, so the performance is going to be 2 points less or more. So in this case, we're comparing a 7% return against a 5% return. Over 25 years, you end up with $2.04 million less in the annuity versus doing it on your own. Now let's talk about the extra taxes that you pay when you buy an annuity. Annuities are tax disadvantaged. They have an extra tax burden that either you or your beneficiaries are going to pay. Annuities do not qualify for stepped-up basis. And that means that when you pass away, any gain in the contract will be taxed as ordinary income to your beneficiaries. So let's compare $1 million investment in an annuity to $1 million investment in stocks or real estate. Let's assume that in both cases, the assets have appreciated throughout your lifetime, and when you pass away, they're both worth $3 million. So you have a $2 million unrealized gain either in the annuity or in your stocks or real estate when you pass away. What happens to your beneficiaries? Your beneficiaries' cost basis will be $3 million. This is stepped up basis for after-tax stocks or real estate. But in the annuity, your beneficiary's cost basis is going to be your cost basis. They inherit your basis, and then they will ultimately pay income tax on the entire gain in the contract. In this example, your beneficiaries would be paying $740,000 in taxes versus no taxes if they had inherited stocks or real estate. It's a huge burden that you will impose on your beneficiaries simply by buying an annuity. Annuities will also impose a tax burden during your lifetime. If you take money out of the contract and the contract has appreciated, you will be responsible for paying income tax on any gains at ordinary rates. It's a really bad deal compared to stocks, real estate, bonds that you've made investments in with after-tax funds, where you would be paying most likely long-term capital gains taxes. You end up paying a lot more money in tax on gains in an annuity than you do on gains in standard investments like indexes, stocks, bonds, real estate, etc. In this example, we're making $1 million investment in an annuity and comparing that to $1 million investment in stocks, real estate, bonds, etc. If the annuity has $2 million in gains and you want to take the money out of the annuity contract, you're going to pay income tax at ordinary rates, $740,000 of income tax owed. Versus if you put $1 million into standard investments in an after-tax account, you have $2 million of unrealized gains, and then you sell it. You get your $3 million, you're going to have $2 million that you owe tax on, but it's going to be at capital gains tax rate. And I've calculated the capital gains here at the highest rate, $476,000. So you have about $250,000 more of taxes owed just by buying your investments inside the annuity shell. So now that we know the true fees for variable annuities and the tax drawbacks, when you add it all up, you can tell right away, this is not a good investment. Why would you ever buy this? I think for most people, it's because a selfish financial advisor sold it to them. If you own annuities or a financial advisor is pressuring you to buy them, please give my office a call. We would be happy to give you a second opinion on your investments. Annuities are often sold on the basis of the lifetime income rider for variable annuities. Let me show you why you don't need to pay for the lifetime income rider and why the lifetime income rider is just a bunch of nonsense. This illustration shows the data behind the lifetime income rider benefit that many financial planners use to sell variable annuities. By attaching the lifetime income rider guarantee to a variable annuity, the financial planner is playing on the client's fear of running out of money, and that is how the annuity is sold to the client, as a protection against running out of money. Purchasing the lifetime income rider on a variable annuity is paying for insurance that you do not need, in my opinion, and this illustration demonstrates that point. When you buy a variable annuity with a lifetime income rider, you are forced to use an asset allocation strategy inside that policy. So what would have happened if you bought an asset allocation strategy on your own 25 years ago and just distributed income to yourself? Let's take a look. Here we are making $1 million investment on January 1 of the year 2000. We're using the Vanguard Balanced Index Fund, and we're taking 5%, $50,000 in the first year, and then making a static $50,000 per year distribution until the year 2024. So 25 total distributions. Look what happened. We made it through not one, but two recessions, and ultimately we end up with $1.1 million after 25 distributions. Here's the data table for the illustration. I won't spend a lot of time on it. I just wanted you to have it for your reference. We start the year 2000 with $1 million. 25 years later, November of 2024, we have $1,051,000. We took a $50,000 distribution every single year. Some of that distribution was income, some of it was principal. I think this is a whole lot better than buying a variable annuity with a lifetime income rider. The annuity company knows that you will most likely die before they ever have to pay anything out to you. That lifetime income rider is totally bogus. It's a misnomer because you're not getting lifetime income. What that rider is a guarantee that if you run out of money in your contract, if you spend all your money, then and only then will the annuity company make good on a claim and maintain the timely payment of your distributions. But they have a series of rules in place to safeguard them from ever having to make payment on a claim. What do I mean by that? They force you into asset allocation strategy, like I just showed you, and then they cap your distribution. So by controlling you, by making sure that you only take out so much money and you use good investment strategy, they get to charge you a lot of money, and they'll never, ever, most likely, have to make any payment to you. They just get a lot of fees. It's a really juicy deal for the annuity company and the financial planner who sells it to you. I hope this video was helpful. I hope it gets you thinking. helps you better analyze your investments and overall improve your family's financial plan.